financial reports. Welcome, Francis.
Thank you, Madam Chair. I also have a presentation to take you through, so if I could do that and then we'll take questions. So this is the first quarter report. It's the consolidated group report, and it's covering just the first 3 months of this year to date to the 30th of September. And you've already had the parent one, so now we're looking at the group. I just remind you also that the individual CCOs have presented to the CCO Governance and Monitoring Committee. So this is trying to look at it, take it up and have a bit of a helicopter view. So the actual results, we are comparing against the original long-term plan budget. And what we've done is we've tried to phase that so that we don't just have the annual budget, but we've tried to phase it so that we could get a little more relevance to the reports for the quarter. And so that you'll see coming through there. If we just move to the next one, which is the actual statement of financial performance, I just wanted to go through and just highlight some of the comments that are there. Just really around rates. While it's slightly below budget, it's really due to penalty income. Penalty income has been lower than we actually budgeted, which is saying that generally people are paying the rates a little better than what we expected, which I think is a good outcome. Around grants, they're behind, and it's to do with public transport projects which are behind budget. It's not that we expect that might be timing as they move through the year. Hopefully those will pick up and those grants will come through. Then the other revenue, the key thing there is actually the DFA, which was referred to earlier, which is obviously there's been some turmoil in the financial markets around the world and continues to be. And so that is not performing as we'd actually hoped it would. But that is slightly offset by some dividend income that was above what expectations. Then the other areas around other operating expenses, and these are just slightly behind. But again, we think this is more timing than anything else. It's just been incurred slightly later than planned. And the final one there is the other losses, which is the fair value, which Jenny alluded to earlier, which is an accounting assessment of just carrying these at fair value. It's not a cash impact. Just got a bit of a graph just to highlight where the revenue versus the phased budget, and I want to stress this is a phased budget, so it's the annual budget which we phased based on our expectation of when we expect the costs will be, the revenue will be received. And as I've highlighted there, you'll see that grants and subsidies. The other one is there's some development contributions that are also just slightly behind schedule. And then I've talked about the other revenue. So those are the sort of the main ones that are impacting on our revenue being behind budget by just short of 100 million. Around expenditure, generally they're on track, other than, as you'll see, other operating expenses slightly behind, and finance costs are slightly behind. But overall, we're not significantly behind, but the key area is really that other operating expenses, and then just bits and pieces of the other expenditure. The statement of financial position, which is the balance sheet. Again, we're comparing here rather than to the budget. We're comparing against the 30 June actual, which was the set of accounts that were approved recently. So on current assets, obviously our rate debtors, because of the way we have to record them and receive them up front, at year end all that's left is what isn't paid, whereas at this stage there's a whole lot of rates that we've had to bill that aren't actually due yet, so it is higher, but that would be normal. Around current assets, they've gone up by about 179 million, and that's mainly obviously the capex that we spent, which we'll talk about shortly, less depreciation, and then there's just some movements in derivatives. And overall, our debt is to fund capital expenditure. The net increase is only about 130 million for the group for the quarter. Just to give you, again, a perspective, just to show that this is flatlining. We're not, our debt is not increasing as a percentage higher than our assets, or as a percentage of assets, so that's flatlining. It's just something that's useful to us, just to bear in mind that we are what's called a low-geared entity. That's normal in our sort of sector that we operate in the local government sector, but it is flatline and it's not an area of concern. When we get to the capital expenditure for the first quarter, for the group, there's been nearly 250 million spent, and as you heard earlier, the council's portion of that was 88 million. So there's a lot being spent around, especially transport and water are the key areas that you can see there, and we've given you just some indication of some of the significant expenditure that has happened in the various areas. But we're on track. It seems like we're on track to actually deliver the capital program. At this stage, there's nothing that's concerning us. Now, the next three slides that I wanted to just highlight, and I'll probably be doing this each time I report, because I think it's important that, given the debt, the level of debt that we do carry, and the concerns that a lot of people have around that, these prudential limits that we have in our LTP are key. They are key because they are used in part by the rating agencies, so it's about ensuring that we maintain our rating level currently, and that is key, because if that were to be downgraded, we would have to pay more interest. So it is critical, and I think it's important that this is just kept in front of your minds. So if you look at it quarter on quarter from last year to this year, there's no change, which is good. Again, it's flatlining. That's important. That's what we're wanting to keep achieving. And by the end of the year, we budgeted to be at about 12.3%. At this last year, we were at 11.7%. We don't see that level or that benchmark is going to be exceeded, and it's important that we maintain and manage that prudently. The next one is just another one around what's called debt affordability, and that's just looking at the amount of interest we pay relative to our rates, and it obviously excludes water care. And for the quarter, we're much of a muchness with where we were last year, and for the year end, we're also projecting that we will maintain and continue to be well within our prudential limit. So we don't see that that's a concern. The final one is debt affordability, and this is just net debt over total revenue. We don't monitor this on a quarterly basis, simply because our revenue can be quite lumpy, and it won't give relevant information. So we just continually make sure that we're on target to stay within the prudential limit by the end of the year, because that's when we have to report and measure it. So at this stage, we are comfortable that the benchmark that we've set in the LTP, we should maintain it. We don't have any concerns, and that is borne out by the fact that if you looked at our revenue and our expenditure, they're much in line with expectations. So then, just to summarise, while, as you noticed, our operating surplus is slightly behind budget, we don't think there are any areas of significant concern. So generally, the actual results are in line with budget. The fair value losses, as I noted, are not budgeted, but they're also non-cash. So it's important that one just remembers that when you look at the real bottom line. And finally, I just want to comment that I think from our perspective, the group continues to manage the financial performance prudently in accordance with the long-term plan. And I think that's probably the key message that I'd like to leave.
Thank you.
Thank you very much, ma'am.
I'll move the report and Councillor Clow will second it. Questions, comments? Councillor Hulse.
Thank you. Just a question, but before I ask my question, which is going to be about the net fair value losses, please explain a little bit more to us non-accounting people, a bit more information about that. But Madam Chair, I just wanted to say those three graphs are so telling. You know, we get a little bit tired of being called the cash-strapped Auckland Council. Actually, we're not. We are in remarkably good heart, and I think any business with a bottom line like that would be crowing from the rooftops. We've got headroom for debt. Our debt is lower, you know, than it would have been projected under the LTPs of the previous councils. You know, we've got a lot that we need to worry about. I'm not saying, you know, let's you know, be breaking open the champagne. There's an awful lot we need to deal with. But it would be really useful if this was the one thing that was clear to our community, because a lot of people are worried, and they worry unnecessarily. We see the letter after letter after the letter to the Herald and other media about our blowout in debt. No. So I don't know what we can do to explain that in really clear ways and in very clear words and in this form to our community, that we may not have got everything right, but we have managed debt superbly. Now my question is simply around the net value, the net fair value losses. Sorry, I'm just a little bit lost with that. I just need a bit more info on that.
Right, shall I? The accounting standards require that, well, let's step back first. We, in order to manage the level of interest that we will pay on our debt, we enter what are called derivatives. In other words, we go to the market, we might borrow on a fluctuating rate. We then say, well, we'd rather know what our actual cost is going to be. So we go into the market and we fix it. Okay? So that fixes it at that rate. The problem is we might, and as you know, the interest rates have been bouncing around for the last few years.
Yes.
Anybody, if you could predict it, you're very good.
Yeah.
So we would fix it. And let's say we fix it at 4. When we come to prepare the accounts, if the general interest rates have moved down to 3.5, we have a loss.
Yep.
The reality is that by the time we come to pay, we're going to pay 4. We knew that, and that's what we fixed. It's almost like we're insuring ourselves that we've got surety. So that's why we say we have to book these. So we book them, we show them separately, but they're non-cash. Eventually, we will pay what we've planned to pay, and that's why we set it that way. But it is something we have to do in terms of the accounting standards that require us to fair value them, and that's what we do.
That's
Does that
really
help?
clear. That's hugely helpful. Thank you.
I can just add a little comment to that one too, just through the chair. That is, remembering this is also where we're actually fixing these for a longer period.
Yep.
So potentially at the moment it may have come down to like 3.5, but what we're actually doing is potentially fixing it at 4
Yep.
for potentially 5, 7, or even 12 years in some cases. So we're actually giving certainty. And so it's just, this assessment is if you had to sell them all out today at today's rate, in theory that's what it would cost you. The fact is we're fixing for a longer period.
So if we look, Madam Chair, at the net, if we netted it all out over a 10-year time frame, chances are we would be
Yep.
in the plus rather.
Yep, that's right.
No, that's cool. That's really useful. Thank you.
And so the Strat Cash Council actually got its credit rating again confirmed by Moody's last week as a AA2. So thank you. Councillor Lee.
Yes, just come back to my concern, the question about the diversified asset funds or diversified fund assets. Councillor Clow has pointed out that a little box next to number of library items borrowed, and that's a kind of a graphic visualisation of the diversified assets portfolio. It's to be honest with you, next to visits to library facilities and library items borrowed, it could be a little bit more legible, but the other box and the comment about financial turmoil, I really do think that a much more comprehensive, serious report focus on the funding assets should be received by this committee from time to time, so that it's a little bit more legible and informative.